Hi, everyone. This is Emily Platt from the Wellspire Investment Team, and welcome back to Markets in 2 Minutes for the month of July. As we cross the midpoint of the year, equity markets have shown impressive returns, with the S&P 500 up over 16%. The unique point to note is that a mere 7 companies contributed to about 3/4 of the S&P 500's gains, leaving the rest of the market relatively flat. The common story being that what worked last year is not working this year. As bad as large cap growth did last year, as well as it's doing this year, and as well as dividend paying stocks did last year, or as poorly as they're doing this year. And you can apply this paradigm across most of the market, particularly in sector performance, as this year tech and telecom are performing well, while energy is down after being one of the only sectors with positive performance last year. The slide here is the performance of the S&P 500 growth relative to the S&P 500 value. And as you can see on the chart, going back to the financial crisis, up until COVID, growth had been outperforming value, but since COVID, growth had been underperforming. Growth stocks reversed a 2-year period of underperformance and are really doing so with a vengeance. This is particularly attributable to artificial intelligence, meaning systems that mimic or simulate human intelligence, which includes companies like NVIDIA. But it's also a function of earnings expectations swinging from negative to positive. Another interesting nuance is when you look at different index providers. You would assume the S&P 500 growth would be outperforming the Russell 1000 growth, given the S&P 500 growth has a tilt to larger names, but the difference is how Russell and S&P define what stocks are growth and which are value. What's warping the dynamic between growth versus value is what you see on the table on the left. When looking at some of the names included in the S&P 500 Value Index, you normally wouldn't expect to see Amazon or Meta, and by S&P definition, Exxon is now considered a growth name. The table on the right is showing the sector composition of the S&P 500 Value and the S&P 500 Growth. What really stands out is the 6% weight to energy and growth, which has historically been considered a value sector. But after the massive rebound in earnings last year, with cash flows improving, earnings improving, and oil prices rising, energy is now a growth sector by S&P definition. Another standout is the 17% weight to technology in the value indices. Right now, value has more tech in the US than it ever has, and more tech across the board. So what does this mean? When you have this type of overlap between the value and growth indices, it starts translating into not having as much discrepancy between large cap growth valuations and large cap value valuations. So they both can be expensive at the same time, and that's what we're seeing today. It's no longer just a style story. With that, thank you for listening to this month's Markets in 2 Minutes.